In this video, we are going to be looking at Walgreens Boots Alliance, ticker WBA. Now, this is going to be a bit different to the normal trade we look because it's not going to be a normal deviational play or a gap play. However, it's going to be based off how far it's really just pushing away from its mean. And again, so I guess when we trade standard deviations, we do look for a mean reversion. However, what we can see in the case of Walgreens is we had their earnings were quite poor. We sold off very heavily off this move, kind of did a pullback, and then we have just continued down. Now, earnings pre-earnings we were at around 1560. You can see we have done basically a 30% sell-off since we've done that move. And so again, that means basically, well, our mean is currently around the same price at 1570. So right now, price is 30% away from its statistical mean. So normally, again, we would expect some sort of reversion to the mean. And so it's really, how do we find an entry away from the mean to start trying to enter? Again, when you try and get those first deviations, cool, you would have got a nice bit of a bounce, not a whole reversion, but definitely a nice bounce play in there. Now, the next deviation to play would be at 950. However, that is quite far off, and we would have to get through the $10 key psychological level. So that's really going to be my main trading plan coming into Walgreens. If we can continue to fall about another $1 to $10, I'm going to look to play that key psychological level, and then look to target our first deviation as a first target. Second target will be our first deviation from the 6 month, and then a final target will be at the mean. Again, these levels, because price has sunk so far, what you'll be able to see is that these these deviations are slightly reducing each and every day. So what this means is if we give a target in this video, for example, it'll be 1150, 1275, and 1570. By the time we get to an entry level, say if it falls to $10, that's where we enter. These levels will have reduced by then. So again, leave just a comment on the video if you need like an updated level, because again, these levels will drop and those will still remain our targets, but it won't be the set price. It won't be 1150 will be our target. It will be wherever this first deviation is to be used as a target. So if we're looking though to enter at 10, we're looking to target these levels. Where are our stops? So we know our entry, we know our targets. Now it's going to be how we calculate a stop on a trade like this, because this is a bit more of a risky trade. We're looking to basically just catch a falling knife. So the way I'll be looking to hedge this risk is one of two ways. Either we just run a straight stop loss, and if we do that, probably just be running it below whatever the second deviation is, depending how far this falls. So right now I'd be looking to have your stop around that kind of 940 level. Reason for that is, again, currently second deviation is around 950. You're going to have that 950 psychological level. So if we start to break that, then again, there's a good chance we kind of just continue to run down all the way to $9. So even if this second deviation moves, I do think that's kind of where the physical stop will be, around kind of that 940, 935, just to kind of give it a bit of room to work out. We could be risking about 5 to 7% on the trade. And again, then our targets are still going to be quite high, considering if we're getting in at $10, if you're targeting right now, or as of right now, our first deviation is 15%, 27%, and then all the way to 56% at our statistical mean. So again, risk to rewards does make sense on this falling knife trade. Now there's one other way we can look to reduce or kind of define this risk, and that's going to be if we don't want to run say a straight stop at 940 or 930, what we can do is we can look to buy some puts. So again, if we're trading say 100 shares of Walgreens Boots Alliance long, we can look just to buy a put option to hedge this. Again, the expiration is going to be more down to you. I'll probably be going out probably 2 weeks to a month out on these. So for example, we use the 28 days out. And what we can see is currently price is around $11 to hedge to head a month out is going to cost you around $50. So again, if we're at $10 at the time, we're looking to do that same risk, it's probably going to cost us around $50 to take that risk. So that would be the same as placing our stop basically at 950, 940. However, it means we only have a month to hedge that risk. However, it means we don't have to run a fixed stop. So again, that's always going to be what you have to decide what you would prefer if you're taking a trade like this, in that if your physical stop would be here, if price obviously comes down to here, you're going to get stopped out if you're trading just shares. However, if you're trading it with the option, you bought the shares at $10, cool. Your put option is $10 as well. So as price goes below here, the put option then starts generating money. So buying shares at $10 a share, looking to buy that put again, that's going to be a $10 strike, and say you pay $50 for that. So again, 50 cents, you times 100 shares, it's going to cost you $50. What this will basically mean is you're taking on that same risk. So your risk will still be around 950 to the downside. However, it means if we temporarily spike through here, we go to say $9 or $8.50, and then goes back above. If we're running the option, we don't have to get stopped out and we can still make a profit on the trade. However, obviously if we're running outright stops, then we're going to get stopped out there. So it doesn't matter if it goes down and then goes back up, no matter what, that's still going to be a losing trade. So again, the option can sometimes be the better alternative to take. It's really just how quickly do you think it's going to happen and how expensive is the option. In the case of it costing $50, and that's where our stop would be anyway. So it's, do you think it will happen within the month? If so, then going for the option would probably be the better choice there. That's going to be my main trading plan over on Walgreens. Again, some little minor things may change within that as these levels change throughout the trading kind of day or week. So that's going to be my main thing I'm looking at, but overall looking to kind of catch it around $10 and just trade it towards its mean is really going to be that main trading plan.